Listen, I want you to picture something. A Thursday morning in March of 2026. A kitchen table in a craftsman house in Minneapolis, Minnesota. His name is Douglas. He is 71 years old. He spent 33 years as a civil engineer for the Hennepin County Public Works Department. He retired in 2020. He has a pension from the county of $2,600 per month. He has Social Security of $2,150 per month. $25,800 per year. He has a traditional IRA with $420,000, from which he is now taking required minimum distributions of approximately $17,300 per year. He has a small taxable brokerage account, generating $4,200 per year in dividends. His total gross income for 2025 was approximately $89,480. Douglas is sitting at the kitchen table in March because his tax preparer just called him with his 2025 state return numbers. Douglas had been following the news. He knew that the One Big Beautiful Bill, signed July 4th of 2025, was supposed to help seniors. He had read that it included a new $6,000 deduction for people over 65. He had also read several headlines in late 2024 and early 2025 suggesting that Social Security taxes were being reformed, that Congress was working on making Social Security tax-free. His daughter had forwarded him an article with the headline something like, "Social Security tax eliminated for retirees." Douglas believed, in a general and unchecked way, that his Social Security was now effectively tax-free. His tax preparer told him his federal tax on Social Security was approximately $4,600, because 85% of his benefit is included in taxable income at the federal level, which the One Big Beautiful Bill did not change for the vast majority of recipients. And then she told him his Minnesota state income tax on Social Security was approximately $1,740 for 2025. Douglas was surprised. He said he thought Social Security was exempt in Minnesota. His preparer explained that Minnesota offers a Social Security subtraction that fully exempts benefits. On Social Security benefits in 2026 are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Douglas's AGI for 2025 was approximately $89,480, which is approximately $5,000 above the limit. Because he is above the threshold, Minnesota phases out the exemption at 10% for each $4,000 above the limit, meaning he loses a meaningful portion of his Minnesota subtraction and owes state tax. Douglas had not planned around the Minnesota exemption threshold. He had taken his full RMD in December without modeling whether a slightly reduced distribution might help. Might have kept his AGI below $84,490. He was $5,000 over the threshold and paid $1,740 in Minnesota Social Security tax that he did not expect, and that he did not need to pay if he had known the threshold existed and managed his income accordingly. That is the state Social Security tax trap, not a dramatic confiscation, a quiet, avoidable, recurring annual cost that accumulates over the course of a long retirement because nobody explained the specific state threshold that makes the difference between paying nothing and paying $1,740 per year. Multiplied across a 20-year retirement, $34,800 in avoidable Minnesota state tax on the same Social Security income that a Florida or Texas retiree at the identical income level pays zero. Douglas is one of millions of retirees in 8 specific states experiencing exactly this, paying state income tax on Social Security benefits that the other 42 states do not tax at all, on top of whatever federal income tax applies under the Section 86 formula. And the confusion is compounded by the fact that the news coverage was predominantly federal, specifically about a bill called the You Earned It, You Keep It Act that would have eliminated the federal tax, but which, as of June 2026, has not been enacted, leaving millions of retirees who absorb the headline without reading the status, believing their Social Security is now federally tax-free, when in most cases it is not. Smash the like button right now. The 8 states that still impose state income tax on Social Security benefits in 2026 are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. The number has declined from more states in prior years as West Virginia completed its phase-out in January of 2026, and Kansas, Missouri, and Nebraska eliminated the tax in 2024. But 8 states remain, and in most of these states the tax applies only above thresholds, meaning the tax is avoidable through income management for a meaningful percentage. Every like on this video puts this analysis in front of one more retiree in one of these states. who is being incorrectly informed by headlines that their Social Security is now tax-free. Hit it, subscribe, flip the bell. The suits and legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of state income tax. Fine, this is not financial advice. This is a forensic examination of state income tax. Treatment of Social Security benefits in the 8 states that still impose the tax in 2026. The specific income thresholds and exemption mechanics in each state. Consult a CPA licensed in your specific state who models your Social Security exposure and the income management strategies available to keep income below the exemption. Let me start with the foundational architecture that explains why state taxation exists. What I can do is show you the state-by-state thresholds in the math. The federal Social Security tax is imposed under Internal Revenue Code Section 86, which requires up to 85% of Social Security benefits to be included in federal income once provisional income exceeds specific thresholds. Those thresholds are $34,000 and $44,000 for married filing jointly at the upper limit for 85% inclusion. These thresholds have never been inflation adjusted since they were set in 1993, meaning more retirees fall into the taxable range every year simply due to inflation. The One Big Beautiful Bill of 2025 did not eliminate or modify the Section 86 tax. It provided a temporary $6,000 senior bonus deduction through 2028 that can indirectly reduce the amount of Social Security that ends up taxable. But the fundamental Section 86 mechanism remains entirely intact. State Social Security taxation is an entirely separate and parallel system, operated by individual states under their own income tax codes. A state that chooses to tax does so through its own statutory mechanism. A federal change does not automatically change what any state does. States that conform to federal AGI generally include the taxable portion of Social Security, unless they have enacted a specific state-level exemption or subtraction. The 8 remaining states have each enacted their own specific rules with thresholds. Above those thresholds, the subtraction phases out at 10% for each $4,000 of income. Now let me walk through each of the 8 states with the specific 2026 thresholds. State 1, Minnesota. Minnesota offers a Social Security subtraction that fully exempts. For single filers with adjusted gross income at or below $84,490, and for married filing jointly at or below $108,320 in 2026. Above those thresholds, the subtraction phases out at 10% for each $4,000 of income, or 10% per $2,000 for married filing separately. Douglas was $5,000 above, losing approximately 12.5% of his subtraction. The tax rate depends on income, with rates ranging from 5.35% to 9.85%. For Douglas, the rate is 6.8%, producing the $1,740 in state Social Security tax that surprised him. The management strategy for Minnesota residents: keep AGI below $84,490 by managing RMD size, timing large IRA distributions, and using QCDs to satisfy charitable giving without adding to a GI. A $5,000 QCD would have helped, bringing his 2025 AGI down to approximately $84,480, just below the threshold, and would have eliminated the $1,740 state tax on Social Security entirely. The QCD cost Douglas nothing in additional tax because it goes to charity. It saves him $1,740 per year. Over 20 years, that's $34,800 in cumulative savings, amounting to savings from a planning action his preparer never mentioned. State 2, Connecticut. Connecticut exempts benefits for single filers below $75,000 and for married filing jointly below $100,000. Above those thresholds, it taxes. Above those thresholds, Connecticut taxes up to 25% of Social Security benefits, with the taxable percentage capped at 25%. Rates range from 2% to 6.99%. A Connecticut retiree with a GI of $85,000 owes tax on 25% of the taxable part. For $26,000 in benefits, they would owe tax on $5,525 at the 5% rate, generating approximately $276 per year. The cap significantly limits the damage. State 3, Colorado. Colorado applies the exemption based on age, not income. Residents age 65 or older may fully subtract all federally taxable benefits. Colorado's flat state income tax rate is 4.4%, regardless of income level. Residents between 55 and 64 may deduct benefits only if AGI is below thresholds, at or below $75,000 for single filers, or $95,000 for married filing jointly. Turning 65 eliminates the Colorado Social Security tax entirely, regardless of income. A 63-year-old with $110,000 of AGI owes tax on the part above deductions. The Colorado age 65 cliff is the cleanest exemption among the 8 taxing states. Before Montana, let me address the confusion costing millions of retirees money. The You Earned It, You Keep It Act proposed eliminating federal SS tax. As of June 2026, that bill has not been enacted. The tax remains in force. The One Big Beautiful Bill provided the senior bonus deduction through 2028, which can indirectly reduce how much Social Security is taxable, but it does not eliminate the Section 86 inclusion calculation entirely. The confusion between proposed and enacted legislation has caused problems, and face unexpected balances due at filing time. Confirm with a CPA. State 4, Montana. Montana taxes using the federal provisional formula. If income is below $25,000 for singles or $32,000 for couples, no tax applies. Between those and $34,000 or $44,000, benefits become partially taxable. Above $34,000 or $44,000, up to 85% is subject to Montana income tax. Montana's income tax rate is a flat 5.9%. For moderate income retirees, Montana essentially applies its own second layer of taxation on top of federal. State 5, Vermont. Vermont exempts Social Security for lower income, for single filers with AGI below $50,000 and married jointly below $65,000. Partial exemptions apply up to $60,000 for singles and $75,000 for joint filers. Above those upper limits, Vermont taxes Social Security at applicable rates, which range from 3.35% to 9.75%. A VT retiree with AGI of $70,000 owes tax. Tell me in the comments right now. Tell me which of the 8 states you live in. Tell me your approximate adjusted gross income from all sources for 2026. Tell me whether your income is above or below your state's threshold. Tell me whether you have confirmed the current threshold with a CPA. Drop the numbers in the comments. I read every single one. State 6, Rhode Island. Rhode Island exempts benefits at full retirement age, which for anyone born in 1960 or later is age 67, and below income thresholds. For most, only retirees with federal AGI of $107,000 or more pay Rhode Island tax. The relatively generous $107,000 threshold means a significant majority owe nothing. The tax applies primarily to early drawers and higher income retirees. State 7, New Mexico. New Mexico has taken steps to reduce SS taxation, including exemptions for many lower and middle-income retirees, exempting the full benefit for single filers below $100,000 and joint below $150,000. New Mexico is among the least aggressive of the 8 remaining states in terms of how broadly the Social Security tax actually applies. State 8, Utah. Utah taxes all income at a flat 4.5% rate. However, Utah provides a Social Security benefits credit that eliminates the tax. The full credit applies for single filers below $45,000 and married below $75,000, with the credit phasing out by 2.5 cents for each dollar of magi over those. Recent Utah legislation raised these thresholds to approximately $54,000. For a Utah retiree with magi of $60,000, the credit begins to phase out. Now let me model the cost across 3 profiles to show the real numbers. Profile 1, the retiree just above. A single MN filer with AGI of $92,000, which is $7,510 above the $84,490 threshold. They lose part of the subtraction. This produces approximately $280 per year in state Social Security tax. For this retiree, a QCD of $7,510 would eliminate $280 per year in tax. Profile 2, the retiree well above. A married Vermont couple with AGI of $90,000. This generates approximately $2,890 per year in Vermont state tax. A QCD of $15,000 reduces their AGI to $75,000 just at the exemption limit, potentially eliminating the $2,890 annual Vermont tax entirely. A Connecticut married couple with AGI of $95,000 below the $100,000 joint filer exemption owes zero Connecticut state income tax on Social Security. The same couple with AGI of $115,000 would owe tax on 25% of the benefit. Now let me show you the 3 income management strategies available before December 31st. Strategy 1, the QCD. This is the Douglas strategy that could have saved him. If you are over age 70 and a half and have charitable giving intentions, a qualified charitable distribution from your IRA up to $105,000 per year satisfies a portion of the RMD without the distribution entering a GI. A QCD in the amount of the excess can reduce your AGI to or below the threshold. The QCD serves double duty, giving to charity and eliminating state tax. Strategy 2. The Roth distribution instead of the IRA for discretionary spending. If non-discretionary income brings you close to the limit, fund extra from Roth. Roth distributions do not enter AGI. They do not affect the state tax calculation. Using the Roth preserves both federal and state tax positions simultaneously. Strategy 3. Timing discretionary IRA distributions across 2 tax years. Splitting a large distribution allocates the income to 2 separate years. The December distribution in year 1 and the January distribution in year 2 are each smaller and each more likely to remain below the state Social Security exemption threshold. Now let me give you the geographic comparison that makes the value concrete. Using the Vermont example from the 247 Wall Street analysis published in June of 2026, a Vermont retiree age 68 with $30,000 in Social Security and $40,000 in IRA withdrawals has total income that clears the Vermont exemption threshold, generating state Social Security tax of approximately $1,500 to $2,500 per year, depending on the exact Vermont rate applied to the taxable portion. Over a 20-year retirement, that accumulates to $30,000 to $50,000 in Vermont state Social Security tax, paid on income that an identical retiree in Florida, Texas, Tennessee, or any of the other 42 non-taxing states in DC pays zero state tax on. The federal layer is the same for both. The state layer is geography specific. Managing below the Vermont threshold through QCDs and Roth sourcing eliminates that $30,000 to $50,000 lifetime cost without requiring relocation. Save this video to your private library right now. Hit the save icon. Add it to the retirement survival playlist. Because Douglas was sitting at the kitchen table in March with a $1,740 surprise state tax bill on Social Security income that he could have eliminated with a $5,000 QCD he was planning to make anyway. He had the charitable giving intention, he had the IRA balance, he had the age. He did not have the threshold in front of him before December 31st closed the planning window. The threshold for Minnesota single filers is $84,490. Douglas had $89,480 of AGI. He was $4,990 over the line. A QCD of $4,990 eliminates $1,740 per year in state Social Security tax. That QCD will be on Douglas's calendar for the rest of his retirement. Subscribe if you have not. Flip the bell. Comment with your state from the list of 8, your approximate AGI, and whether you are above or below your state's exemption threshold. Tell me whether you have had this calculation done by a CPA in the context of your specific income picture. I read everything. The 8 states that tax Social Security in 2026 are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. In most of them, the tax applies only above a specific AGI threshold that is entirely manageable through QCDs, Roth distributions, and income timing for retirees within reach of the threshold. The tax is not inevitable. It is an information problem masquerading as a law problem. The law is the same for everyone in the state. The information about the threshold and the 3 strategies that keep AGI below it is what determines who pays and who does not. I will see you in the next one. Stay strategic. Stay informed. Know your state's threshold and manage your income accordingly. The difference of just $1 in Minnesota can cost $1,740 per year for as long as Douglas is alive. That is not an abstraction. That is a QCD away from the answer. I will see you in the next one. Stay strategic. Stay informed.